All right, today we're going to crack open what is basically a time capsule of investing wisdom, Warren Buffett's 1979 letter to his shareholders.
We're going to start with this little gem right from the letter. Short, to the point, and it completely goes against this fantasy a lot of investors have, this idea that you can buy a struggling company for pennies on the dollar and be the hero who turns it all around. Yeah, as we're about to see, Buffett learned the hard way that sometimes a bad business is just a bad business.
And this really gets to the heart of what we're doing today. In our world of algorithmic trading and 24/7 news cycles, what can a letter from the disco era possibly teach us about investing now? Well, the answer is pretty much everything that actually matters.
To really get what Buffett is saying, you have to picture the world he was living in. The late 1970s were, to put it mildly, not a great time for investors. The whole economy was just getting slammed by crazy high inflation and a whole lot of uncertainty. It was a really tough environment.
14%. Buffett calls this out specifically in the letter. At that kind of inflation rate, the money you had sitting in a savings account wasn't just standing still. It was actively and scarily losing its value every single day. This was the economic storm Buffett was trying to sail through.
But here's the thing. In the middle of all that chaos, Buffett didn't come out with some super complex new formula or a list of hot stock tips. Nope, he just laid out a really clear, simple roadmap, and it was all built on a few powerful common sense principles. And the very first one is all about how you keep score.
Okay, first up, the scorecard. Buffett's argument was simple. If you're going to own a piece of a business, you have to know how to measure if it's actually any good. And you know what? Most people were looking at completely the wrong numbers.
On the left, you've got what Wall Street obsessed over then and frankly still obsesses over today, earnings per share, or EPS. But Buffett basically argued that EPS can be incredibly misleading. He said the real test, the metric you should actually care about, is over on the right, return on equity, or ROE.
So, what the heck is return on equity? Well, think about it like this. If the business was your savings account, ROE is the interest rate you're earning. It asks a really simple but powerful question. For every dollar the owners have invested in this company, how many cents of profit is management able to squeeze out each year? It's a direct report card on how well they're using your capital.
And here's Buffett in his own words. The primary test of how well a manager is doing is that high rate of return. See, it's pretty easy to grow your earnings per share if you just keep adding more and more money to the business. But to generate a high rate of return on that money, year after year, now that is the signature of a truly great business.
All right, let's move on to the second big principle. And this one's a lesson that Buffett is very open about learning the hard way. And honestly, that's what's so great about this letter. He's not afraid to tell you about his mistakes to teach you something important.
He tells the story of this textile company he bought called Wombbeck Mills. Now, on paper, this thing looked like an absolute steal. He said he bought it for way less than what its assets were worth. It was what he called a cigar butt investment. You know, you find an old cigar on the street and there's one good puff left in it for free. That was the idea.
But here's the catch. A bargain price can't fix a terrible business. Buffett is blunt about it. He just says the purchase was a mistake. He explains that it was like playing whack-a-mole. Every time they'd solved one problem, two more would pop up. The business itself was just fundamentally broken.
And this brings us to that crucial takeaway, one of the most important in all of investing. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The quality of the business itself is so much more important than getting a deep discount. And this insight, born from a failure, became a pillar of his whole philosophy.
Okay, for our third major theme, we're circling right back to that 14% inflation rate we talked about. Buffett spends a lot of time on this, warning everyone about what he calls a hidden tax that just silently eats away at your wealth.
He even made up his own little metric to drive the point home, the investor's misery index. It's simple. You just take the rate of inflation and you add the taxes you have to pay on any investment gains. If that total number is higher than what your investments are returning, well, you're actually getting poorer. Your purchasing power is going down, even if your account statement says the numbers are going up.
And to make this really concrete, he shares this absolutely stunning fact. After 15 years of compounding Berkshire's value at over 20% a year, the company's total book value could buy the exact same amount of gold as it could have back in 1964. Inflation had literally wiped out 15 years of spectacular growth in real, tangible terms.
He points out that the government is really good at one thing, printing money. But you know what they can't do? They can't print gold or create oil.
So, after our little trip back to 1979, what are the big principles we can pack up and bring back with us? How do we apply this wisdom to the market today?
Let's just quickly summarize the biggest takeaways.
First, focus on the real scorecard. Return on equity is a much better test of a business than earnings per share. Second, remember Wombbeck Mills. Quality over price, always. A great business at a fair price is way better than a fair business at a great price. Third, never, ever forget that inflation is the enemy. You have to think about your returns after inflation and taxes. And finally, think like an owner, not a gambler. Find managers who talk to you honestly and who are focused on the long haul.
And that really leaves us with one final thought. In a world that is obsessed with the next new thing, the latest trend, the next disruption, is it possible that the most valuable wisdom is the stuff that's the most timeless? Thanks for watching.